Hi everyone, this is a short screencast for Independent Colleges Dublin covering question 2 of the mock exam for F6 taxation for December 2014. And what I'm going to do is just run you through the requirements first for part A and then the balance of the question. You'll see that part A 1 and 2 we have the classic corporation tax style question of calculating assessable income, i.e. dealing with addbacks, etc. In part 1, and then in part 2 a final corporation tax liability. So I guess one of the first things you've got to think about here is your format for your answer. Page 1 is going to be your setup page with your net profits and your adjustments, and hopefully page 2 and indeed page 3 are going to be your corporation tax computation and your working. So do have a fix on that before you put pen to paper. Okay, so just looking at the body of the question, as I said within the video tutorial for question 1 of this exam, I'll just take you through the main points and not every single number. As I said before, pretty standard setup here. Our starting point obviously is going to be our net profit, and as we scan down the page we'll see a variety of different notes in relation to different expenses, and certainly some areas are a lot easier to deal with than others. We've got the normal ones that you expect, like depreciation. That should be first on our list of addbacks. And we've got the standard tricks, things like pension contributions and indeed legal fees that you would expect to see in a question of this kind. Okay, so dealing with this administration expenses first, what I'd be looking to do obviously is scan down, but also obviously read the relevant notes. And I'm going to focus in on this pension area first, which is note number 2. Okay, and what we'll see here is that an amount was paid, an amount accrued. So we should know that all we're interested in relation to pensions is the payment, the paid amount. And it may well be that you find working with a T account useful for that. I certainly do, and it gets the right answer very quickly. Or you may be able to do it just simply by pluses and minuses. Really up to you, but concentrate on finding what is paid, and obviously anything else is going to be added back or is irrelevant in some way. Okay. In terms of the legal fees above here, we have 267 for legal fees, and we have included in that figure 60k in relation to shares. So key trick on legal fees is whether or not the item is of a capital nature or not, and that certainly sounds like it is capital, so I would suggest we'll be adding that back in the computation in the workings. Okay. Down from there we have some detail in relation to an industrial building, and that's a very, very common area in the F6 exam, and I think the reason that it's common is that it's complicated in places, and there are so many different ways in which the examiner can come at it. The particular way that the examiner has come at it this time is the disposal of an industrial building, and in that case, really, I think the key thing to remember is that buildings are going to rise in value. So, 99 times out of 100, the figure that we're going to get is going to be some sort of charge, a balancing charge, because all of the allowances will be clawed back. Okay. We should also note, obviously, that we have a 25-year finite life for industrial buildings. So one of the key issues for us here is really to establish how much allowances have been given, because if we're looking to in effect rebate to the revenue all the allowances, we need to know what they are, and in that sense we need to go back to 2005 and really calculate what allowances have been given. One or two other issues in relation to what we're going to include in the original value, I'll come to that when we come to the answer. Okay, so just going back up the question for a second, we sort of touched on pensions, we touched on the legal. They have done something that's a little bit unusual here in relation to this profit of 121. You'll notice that this heading is for administration expenses, and unusually what they've done is that in relation to this figure here of 2136, they've included in effect a negative expense. So they've included a profit. Okay, and we've just got to remember in our addbacks that that's really going to reverse things. I mean, normally speaking, income, which in effect a profit would be included within some other income listing. Yeah, but in this case, what they've done, just to try and trick us, is included within administration expenses. So just be careful with things like that. It sort of reverses our thinking, as you'll see within the answer. Okay, moving down the page. A couple of other key areas here outside of the industrial building. We have some issues in relation to interest. Obviously, a prompt here on trading for or trade purpose for the overdraft interest, as you would expect. But also we have some interest on a loan to buy shares. Looks like that's of a capital nature too. Okay. Um, next part of the question deals with one or two things that are fairly common. The deposit interest should be fairly easy to deal with. We're just going to slot that into the computation. Dividends, it's a question as to whether or not these dividends are taxable or not. So we need to just figure our rules on dividends being received from another Irish entity. A little bit of a tricky one here in relation to branch profits. And the key thing with branch profits to remember that is that, really an individual company has a choice when they're operating overseas between operating as a branch, which is really just an extension, if you think of it a little bit like an arm stretching out to a foreign jurisdiction. But those profits are certainly taxable in the Irish state. It's not a separate entity. It's not a separate subsidiary as such. So in this case, we can see that it's a branch. So we can see that this income needs to be included in some way, shape or form. I think the problem for us is this issue of this tax that's been deducted within the UK and dealing with this issue of DTR or double taxation relief. So more of that later. Final point here, just in relation to capital allowances. This is just the sort of thing that perhaps a student under the stress of the exam wouldn't include. No adjustment to make here. We're just simply slotting this into the computation, subject to obviously the balancing charge figure. Okay. So really we have two parts here. I'll deal with these one by one, and then we'll deal with B in a moment. So let's look to the answer for part A1. So as I've said, pretty standard format. We know our starting point. Watch for that. Our addbacks are, sort of what we'd expect. Certainly, let's get the easy ones in quickly. Things like depreciation or indeed political party donations. The pensions, we know that it's paid versus accrued, so we'll see that we're adding back the accrued element. Not too complicated in this case. The legal fees had to go back because they were of a capital nature. And then we have this issue of this profit that's included within the administration expenses. And you remember what I said, it's a little bit like a sort of a negative expense. So in essence, although the adjustment is the same as it is here, it's sort of negative as an add back. Okay. Bank interest that you'll see has been added back because of the share side, and indeed the branch profits here. A little bit of detail down below on that, but in essence what you see here is two entries. You see that there's a figure being in effect added back, or indeed added to our profit of 228. The working on that will be a little bit down below. And included within this 280 is really the full value, the 250k. Okay. Now I'll just draw your attention to a slight error in the balancing charge calculation, and I've had to adjust some of these figures, which you'll see here, the red figures and down below. Apologies for that, but you'll see that there was a slight error in relation to the number of years. So more of that in a moment. So basically, for Sun Limited, we've got a series of items that we're adding back, and one or two of them may be decisions that we need to make on the day. We have a 50-50 chance of getting it right, but certainly I'd encourage you to make decisions quickly. Once we've dealt the expenses outside of that 121, we get to this figure of 1271, and here obviously where there is other income, whatever it is, it's going to be deducted because it's not going to be case one relevant. So that 280 clearly is being deducted. The capital allowances, we'll see the working down below. I'll take you through that in just a moment. And then we get to the 965 figure. Okay. This figure here is just the adjusted balancing charge. In effect, it works out rather than being a balancing allowance, is a balancing charge net of 64. Okay. So the capital allowance is working. We just take a look at that, and you recall that what we were shown within the body of the question was really the sale of a building. And what you saw that we needed to do really was to see Well, what are the allowances that have been given in relation to the sale of that building? Because the building, as with all buildings generally, will increase in value. So it seems highly likely that all of the allowances that have been given will be clawed back by the revenue. So what we needed to do, if we just go down the page a little bit, is really to calculate what the allowances were. Okay. Now, the first starting point for that is really to say, okay, going back to 2005, what was the value that we used to calculate our industrial buildings allowance? And as always, with the values, we exclude any site cost, any sort of land cost. We won't receive any industrial buildings allowances on a site cost. And obviously there are one or two items as well. I draw your attention to those not dealt with in this question. But certainly the development cost and the building cost are okay. That's where we get our 270. So that was our starting point. Okay. So if that was our starting point, how do we apply the standard sort of industrial buildings rules to a figure of 270? Well, really all that we would have done is taken the rate of 4% and applied it to that amount in year 1, year 2, etc. But the key thing, and I think the mistake that was made within this particular question, or answer indeed, was how many years? And in effect, we have 8. Okay. So really what we're trying to do is find the allowance and indeed find the tax written down value. So if our starting point was 270, as mentioned above, and we have 8 years at 4%, then in effect the difference is going to be the tax written down value of 183,600. And obviously, if we take one away from another, you'll see the figure of 86,400 above. Okay, so that's where that figure of 183,600 comes from. And if we look above here, what we'll see is that where we're looking to establish what a balancing charge or indeed allowance is, we're comparing proceeds to tax written down value. So if we do that here with the net proceeds after legal fees have been deducted, we'll see that the balancing charge in the first instance is 216. But obviously we can't give a balancing charge for over and above the allowances given, and that's why we're restricting the allowances, and that's where we get this figure of 86,400 above. Okay, so this is the figure that was incorrect based on, in fact, 5 years rather than 8. Okay, so really what we see here then is an adjustment for that 54 to 86.4, which gives us a net of 6.4 rather than 26 as an allowance. So this is in effect to be added to our income, as it were, or added to our profits. Okay, so that's essentially the capital allowances figure. Just take you through the figure above. You remember that when we were looking at the addbacks in relation to the branch profits, we had really 2 entries there. We have branch profits gross, and we have the full amount, including the UK tax, included within other income. Okay, you'll see if I just take you to the other income here, you'll see that we have 200 included within other income. That's obviously all of that is being added back because it's not relevant for case 1. And then in terms of the figures, we get some detail here of the branch's tax adjusted profit. So in effect, the net amount of 200, and then if we add on the tax, we get the 253. Okay. So really what they're saying within the answer here, in order to make this adjustment, is, well, let's include the net of 200 along with the 12.5% gross up for the Irish corporation tax. So really that's where that figure comes from. I'll take you back to the note just in a moment. This figure is increasing our profits, by the value of 200, which is net foreign income plus Irish corporation tax grossed up 12.5%. Obviously the amounts excluded completely here. So if we could just go back to the note, what you'll see is that they've simply said, excuse me, they simply said that if we have a corporation tax or a foreign corporation tax of 21%, the first thing to do is to take that tax out of the gross amount, and that gives us the 200. So in other words, calculate the net income figure. The next thing we do is to gross up with the Irish rate, and that's what they do here. So the 200 times 100 divided by 87.5 gives us that 228,571, which we're adding back above, and therefore, in effect, including that within our trading profits, because it is trading income. It just happens to be from a foreign branch. The next thing that we do, and you'll see below, is that we include this amount in the computation, this 228, because that's not really our taxable figure, as it were. And the next thing that we do is to deduct the DTR, and the DTR is obviously based on the lower Irish tax rate, which is 12.5%. Okay, so a little bit complicated. Do revise that if it's not overly clear, and I'll show it to you within the computation now. Okay. So here's the computation, and you'll see that we've got adjusted figures here because we had to adjust the add-backs above. So we're asked to provide a corporation tax liability or comp. You'll see that it's a fairly straightforward sort of setup, really just a list. And what we're required to do here is really slot the information in. Now, we have this figure from above, yeah, from part A1, so that's okay. This is just the case 3 interest coming in at 50. Key point here, Irish dividend income, i.e. income or dividend income from another Irish entity, is exempt. Do make sure you put it in, because you will not get that half mark if you don't. If you simply exclude it, I cannot see you getting that mark. So make sure you make the point to include it, but obviously at 0. Okay. In terms of the capital gain, I'll come back to that in a second. That was fairly straightforward. And then we've got some non-trade charges, which we'll see when we go down, that we're just going to simply take against the case 3 income. Okay. So in terms of a sort of a broad view on the comp, the key thing so far really is the capital gain. I mean, the income is not overly difficult to get. One part we've got from above, case 3 interest is okay, dividend income is irrelevant. It's really this area of the capital gain. So if we go down to the working on the capital gain, this is obviously in relation to the building. Again, the information was provided, and if in doubt within capital gains types questions or CT questions involving gains, let's always at least get or try to get a 3-liner out. That's proceeds less cost equals gain. And that's really what they do here. They get down to a gain of 90, no indexation relief relevant, and they do remember, thankfully, to gross it up. You remember that we have to gross up for corporation tax purposes in order that we can apply our 12.5% rate. Okay, so that's where the figure of 237,600 comes from. Okay, so if we move back up to the comp, we'll see that we simply applying here the relevant rates to the relevant items. And in relation to this 20,000, you'll see that the interest is being offset against the case or the case 3 deposit interest, and that's applied at 25%. Okay. The balance obviously at 12.5 as per normal, and this is the adjustment that I mentioned in relation to the branch profits. So in effect, this 228, yeah, is included because we've added it back, yeah, within the add-backs above. Okay, so if it's included, then we're just looking to apply the deduction, as it were, for 12.5% as a negative, because bear in mind that this amount of income or branch profits has already been taxed elsewhere, and we're trying to give some relief for it, and quite a lot of marks for getting that right and including it. And then we get down to our tax payable here. Okay, so in essence, that's the main. Those are the main parts of part A1 and 2. I'll just move you on now to part B, which deals with groups, which is another common topic within this area of CT. Not an overly complicated question for us. I mean, really what we have here in terms of a requirement is really, in the first instance, sort of a definition of a group. Why are they in a group? And so quite straightforward. We need to remember our percentages there, and there's really one key percentage to remember, as we know. Okay. Second part, CT liabilities for 3 companies, given that there is a group, and we'll see the numbers above. I'll come to those in a moment. And they're looking to avail of the relief as early as possible. Key point here that they make, and this is important to gain good marks in this area, is that obviously we would want to ensure that the order of the losses is correct. In other words, that we recognise that Kerry, given that it has the trade loss, is going to apply the correct order. So it's a question of, well, what is the correct order when you've got a standalone company with a loss with other income, and then over and above that you have several group companies as well. Okay, so that's a key little area here. 8 marks available for making a good attempt at that. Okay, and the last point is just in relation to capital gains and indeed capital losses and offsets and planning issues, which we'll see when we come to the answer. Okay, so in terms of the body of the question, well, it's fairly straightforward that we're prompted that there are 3 subsidiaries and that the percentages are certainly higher than 75. So it seems clear that there is a group, or indeed a loss group, with 3 companies in it. And we'll see from the income information here that Kerry, as mentioned, has this trading loss, and we've got other companies with other income, including trading income. We also have this issue of a capital loss, and there's a key rule that we need to remember, given the fact that we know that there's some sort of upside of being in a gains group, but it's just a question as to what that upside is. In other words, can we transfer gains and losses? I'm not sure that we can, so that's maybe what they're referring to in that final part. Okay, so if I take us through the answer now, the first part was fairly straightforward, and indeed only 1 mark for it. The companies are in a group clearly because of that holding. Yeah, and do bear in mind that that definition can be extended for voting rights, dividend rights, and indeed assets in the winding up. It wouldn't have been any harm to include that there if you could do it quickly. Although we're going to get the marks simply for saying that there's a 75% holding, therefore they're in a loss group. In terms of the computational side on this part 2, key thing I think is just the format. Clearly they're dealing with 1 company at a time, and the first company that they're going to deal with is the company that has the loss itself. In other words, it has the trade loss, and that's Kerry. Okay, and the thing that we need to remember really is that Kerry needs to offset against its own profits first. We also need to remember that if we're offsetting a trade loss against other income, it has to be on a value basis. And how does the value basis work? Well, we just simply calculate the tax and then just apply that element really at 12.5% and ensure that we put this value in the loss memorandum. So for Kerry, fairly straightforward, just set up the computation, do it in the normal way. The loss relief doesn't really affect Section 396B, doesn't really affect us until we get down having calculated the tax, and you'll see that we end up with nothing to pay for Kerry. Okay. I'll come to the loss memorandum in a moment. Just take you through Cork Limited. Really same sort of thing. The chargeable gain was adjusted anyway, so what you see is really a normal computation, nothing overly complicated until we get down to the calculation of tax here and indeed here. And really what we're looking to do is really to apply the loss relief in the normal way, and you'll see that it's simply applied indeed on a full basis here rather than a value basis as you see above. Okay, and this also transpires into a nil tax payable. So not overly complex and 3 marks available there. Okay. So moving down to Waterford, again, multiple forms of income here, and we actually, I think, sort of run out of losses, as we'll see from the memorandum in a moment. Pretty simple, straightforward calculation. We've got the value basis being applied to life, not the value basis, actually the full basis against the case 1 income, and we're left with the 14,000 case 3 income being taxed at 25%. Okay. Now there are other approaches, as they note within the answer, to this particular answer format, or indeed the way that they relieve the losses. So several possibilities, but the one that they've shown is probably the most simplest one, I think. In terms of the memorandum, we're always going to include a loss memorandum within a loss question. And what you'll see is that, simple columns, we don't need 2 necessarily. I think we just need to know how the loss is being relieved. So I'd be inclined to maybe stick to this, perhaps we're putting this in for tutorial purposes. It's very simply the correct order sort of laid out, and the remaining loss is nil. Okay. Do note that the capital loss is going to be carried forward. We cannot transfer a capital loss within a gains group to a company that has a capital gain. We can transfer assets, but not losses and profits. Okay. Next point here is in relation to point 3. It's just really what I've been mentioning about this capital loss situation, and certainly capital losses can't be set against other income. We should know that, and they can't be surrendered as I've just mentioned. So in terms of a planning point, what they could do is really sort of transfer assets so that gains and losses arise in the same group company. That would mean, in effect, an automatic set-off. So just watch out for that slightly quirky thing. Losses cannot be transferred. So certainly try and avoid doing that. That's about it. Thanks for listening to this question 2, question 3, 4, and 5 to follow.